All right, let's do this. All right, so guys, what we're going to do today is we're going to talk about how to evaluate a marketplace. So maybe you aren't sure you want to invest in your marketplace. So what you should have already watched by now is the seminar I do on market timing and market anomalies, right? Because those we're going to talk about, but you need to understand those terms. Those are basic. Those are the most basic things. And so carry that chart around, print the market timing chart, and then you can actually make notes on it and try and figure out, put it in pencil and try and figure out, where different marketplaces are based on different factors, right? And so, but there's a couple other factors I want you to take in consideration. So I'm going to give you some tools and how to start evaluating a marketplace, and then really boots on the ground, you go look at these properties. There's nothing that beats getting involved in the marketplace, watching it, looking at what's recently pended, how long did they take to sell, what the price ranges, and monitoring the sales and the listings as they come on. But you can, within a 30 to 60 day period, you will know exactly what's going on in the marketplace. And then you can also go backwards and learn as well. If you're a realtor and you don't go out and see property just because you don't have a buyer, you're just kind of missing it. You are not learning. You do not know anything going on in your marketplace. Jason and I recently were on the road for a couple months, and so at home, first thing we had to do when we got home was get our boots and get in the car and go see property so we could learn what had happened to our marketplace, because it changes, right? It's not a stagnant thing. It's always changing. Every marketplace is, and so we always want to be talking about it, communicating with each other, looking at statistics. And so you don't want to, not everybody knows the information you're about to learn. Very few. If we, the market timing and market anomaly thing, if we line up 100 realtors, one of them maybe knows about it. This is ridiculous, right? Same thing, you go to an investor meeting, most of those RIA meetings, 90% of the people don't do anything. They don't know anything. Don't cling on to them. You can ask. So there are some diehards who kind of know what's going on, but sometimes they are also affected by whatever part of the marketplace they're concerned with. Maybe they're apartment building people. Maybe they don't like certain neighborhoods. So things where you're making money, they don't even invest in that. So you have to learn this and figure it out yourself so that you get the deals, right? And you make money at this. So with that, I'm going to give you a few tools. So knowing now market timing. So remember, the three phases of every market is the decline, and then so that is a buyer's market. Then we go into absorption, and where we're starting to go up, and we start to absorb those extra units that became available during that decline on the buyer side of the market. And in the absorption time period, we're back into a seller's market where we start using up that inventory. And as we go through absorption, financing gets easier. There becomes more competition from the rest of the market. And then we get to expansion, where we see even more competition, a lot of building going on, and we're teetering. We don't know when we're going to go down again. We're hoping the markets just cycle and we don't have a huge downturn. If our government plays with things like interest rates, or they give incentives, it can affect our market in one way or another. Remember how I said before that, they gave incentives for people, the banks, to keep giving loans with, you didn't need 3 criteria. And so that caused it just go up, exponentially up, and then it came down as well, because it's cyclical. It's going to do that. So what we know is all marketplaces are not at the same place at the same time in a market cycle. And in the last downturn, a lot of markets ended up in the same place because our government played with it, and they were trying to save it and keep it from going into a decline. And it's inevitable, right? And it doesn't have to be a big decline. You just have to be prepared, right? We were prepared. We had 30% equity in all the properties, but when they drop 85% in some neighborhoods and some locations, that you're not expecting. And so hindsight's foresight. But with that, let's go ahead, and I'm going to share my screen and talk some more as we go. So what we're going to do is, okay, so what if we want to consider another marketplace? And so what I'd like you guys to do is if you want to go into another marketplace, you know, and you need a referral, let me know so I can find an agent, or if you have an agent, we can work out a referral type of a thing for the situation we've got with your membership and all that. But you want to gather information from them about their market. You want to know what something's called the absorption rate. And the absorption rate is really for the number of properties that are on the market right now, how long does it take to sell them out if we don't list anymore? So if we have an absorption rate that is less than 6 months, then we are in a seller's market. And if the absorption rate teeters past 6 months, we are in a buyer's market. So we trend, and if it lasts for 6 months, for sure you're in that. So you don't go from a seller to a buyer each month. It generally trends one way or the other. So you're kind of working one way or the other. Another way you can figure it out yourself is by looking at the listings. So here's my MLS. So realtors have this information and they can do it for you as well. The realtors actually, their local board of realtors can print monthly information, and it will show the absorption rate. The realtors sometimes don't know how to get those reports, but they can get it. But another way you can do it is you can say, oh, so in this area, Southwest Florida, in these cities here, how many properties are for sale? And it says over 5,000. So that's not helpful. Let me just go to do one city. I've got to get a smaller number. And so in Cape Coral, there's 2,700 for sales, and we'll do single families. And so, and then what I want to know is in the last 30 days, how many went under contract? So I can program my computer like this. I can say, give me how many are pending right now in the last 30 days. So what's the rate we're selling them, right? So in the last 30 days, 645 went pending or sold, right? So I'm going to back up 645. I forgot what that number is. It was 2,000. So 645 goes into 2,190. And so it's just like a 3.5%, 3.5. So 3.5 months, right? So my absorption rate we're in the 3.5 months for that city. Right? And so, but that city is very diverse, right? So in general, you want to know your market. So when Jason and I were on our motorcycle trip, we went to Denver, and at that time, Denver was 1.9 months, generally Denver, right? And I went to Minneapolis, St. Paul, and St. Paul was 2.1 months absorption time period, right? That's really a big seller market. Now everything kind of eked back a little. And so metropolitan, that's a big area, but you've got in those those communities, so you just have kind of an idea. So that gives you some information. But the other thing I want you to think about is when you're looking at, say you've decided you're buying in this community and you're trying to decide whether to do your deal or not. What I want you to know is that every property type, meaning single family, duplex, apartment buildings, lots, whatever, every property type is different than there can be different than the rest of the market, and different price ranges can be different than the rest of the market. So for example, I was taking some buyers on a tour a couple years ago, and I showed them a riverfront house for $950,000, and I did the after repaired value, and I said the after repaired value is 1.45, and one of the guys got really excited, and it turned out he had money and he was from Indiana and this kind of a thing, and so he met with me and he says, yeah, why shouldn't I buy that property? I said, well, because, and so at that point what I said is, in that community at that time, 1.45 million houses, the absorption time period was 2 years. So for what was for sale, at the rate they were selling, it was going to take 2 years if nothing else got listed to sell that property. So that meant that I had to price that property on the low side. So even though the value was there, I can't tell him how long it's going to stay because we just didn't have enough buyers for that. Now, that property type, it was a more expensive house in the Cape at that time. A couple years later, that price range only might have 9 months worth of inventory. It might be a 9-month absorption. It can change. So at different times, depending on where we're at in the market cycle, different price ranges are more popular. So another way to look at this when you're trying to consider what type of price range you want to do is when you are getting near the top in the cycles, get around the curve up here, we want to be careful because we don't know. Different factors can affect. I mean, the stock market yesterday went down a lot, so can that throw things into a tizzy? Yes. So you want to be prudent, right? So you want to pick a property that in those time periods that a lot of people are interested in. There's a lot of transactions taking place. So for example, let's just go back to this Cape Coral example because that's what my MLS is doing here. And you can do this in your community. And if we were going to look at a house that was in the 500, this is a residential neighborhood, and it's actually pretty affordable. And I'm going to talk more about that in a second too. So there's 117 houses in the 500 to 600 price range, right? And then in the last 120 days, only 24 sold. And okay, I have that at 30 days. So in 30 days. So even go back 120 days. So actually let's keep it on 30 because that's the absorption time period. So if 24 sold, and I said there were 117, so it's got like a 4-month absorption. Now watch what happens when I take it to the 800,000 to $1 million. Then 58 are for sale, and in the last 30 days, only 5 sold. So then we're at really a lot more, 12 months, right? So as the prices go up in this particular area, the timing or the length of being able to sell or how many people are looking at it's lower. It's higher, it takes longer, right? But if I go back down to the 200 to 300 price range, we had last 30 days, 300 properties sell, and we have 800 for sale. So actually that's quite a few. So we're just at a 2.1 month. So we're still in a seller's market, and there's some matches. So it's not a month, it's not 30 days. So actually there's some deals to be had, which makes sense because this community just went through red tide and they're a little shook up still, and they're trying to figure out what's going on. And so I've seen that there's some better deals out there right now. So that's actually what's showing here. So that's how you would decide. So you want to go where there's transactions taking place because you don't want to be only one of a few, right? So you go and you search. You can even search by your property type and your square footage. If you get to, there's some houses that are like really small or really, really big. And if you're what I call an anomaly, you don't fit in the rest of it all, then it's also hard. So you can, if you're kind of unusual in some way, you want to search by that and see, because like a one bath house or a bedroom house, those are hard. People will put in when they're searching 2 bedrooms or more, 3 bedrooms and more. So therefore the little 1 and 2 bedrooms don't even show up if you put them in there in that way. So it's a really important thing to consider when you're going to decide a price range to buy or not. And as you go to each community, this information is public and you can do that as well. But let's go back to figuring out what community you want to invest in, right? So say you're sitting at home and you're like, well, I'm open. So let's check some things out. So what I want you to do, a good place, a lot of people like to go to Zillow. And like I said before, Zillow is fed by our MLS, but for the public, it's there for them to take, and you can explore some things in there. And Zillow lies. There's false information. There's properties that sold in there that look like they're active and they were active a couple years ago. It lies, but it can give you some good information to start with, right? Another place you can go is to look at overall stats is RealtyTrack. RealtyTrack.com, and you can pay for a subscription, or I think they have some free searches too, and you can go in and say, let's look at here's Fishers, Indiana. I just happen to have that in there. And so it'll tell me all kinds of things. How many foreclosures are there? How many are pre-foreclosures? you know, those kinds of things. It'll give you some statistics. You can do an overview. It'll kind of tell you about the community. And so a lot of the big coaching businesses, they gather information from Realty Track and sell it back to their people. So you guys can just get this information yourself from Realty Track, and you can see in Fisher's, here's the summary. The median price is $244, and then there's 68 properties in some stage of foreclosure. Okay, so that's interesting. And then it'll look at what's the population, the cost of living index, the crime index, it's an A+ community, the median income, right? So, and unemployment. So you want to watch those figures, the percentage of vacant homes. And so when you have foreclosures, you have vacant homes where they're being foreclosed. So that's not, if it's like a 10% number, that's something to worry about. But this is an average type of a deal, and this kind of gives you some neighborhoods that are close by and things like that. What else? It's got market trends in here. So you can go into that community and look at market trends, and it's thinking, okay. So so then it'll say the highest availability, see, 200,000 to 300,000, which actually for that income level makes sense, that's the most popular price range. The number of properties per square footage. Now that's easy for these computer people in these programs to do price per square foot because that's what they can pull. They can't go in the house and look at them, right? So they're always going to quote you price per square foot, but you got to be smarter than them, right? You got to know more than this information and don't just get hung up on it. But it'll give you how big the houses are. So you'll kind of see here, you know, actually, so the 200 to 300 range, and they're an average, most of the people are really liking 1,800 to 2,400 square feet. And actually there's a big number, over 2,600 square feet. So I would think they're probably growing families. Number of properties per bedroom, 3 bedrooms or more. It's looking like very few here. So if you're looking at a smash and great deal at a 1 and 2 bedroom, not a big market for you, right? And then they're liking things. There are some older homes, but a lot of the stock was built later. Now, so it's kind of an interesting thing you can do here within Realty Track. Another thing you want to know about if you're selecting communities, and maybe before you go into Realty Track, you say, well, what's a good community? And so what I talk about is the Affordability Index. And so, so the Affordability Index is an index where the average person can buy the average property. So it measures whether or not a typical family earns enough income to qualify for a mortgage loan at the typical home at the national and regional levels based on the most recent income and price levels, right? And it's supplied by the National Association of Realtors as a reference. So, okay, so here's a site. I'm giving this to you in a document enclosed. And so you're going to go to this website and you're going to say, okay, well, show it to me then. So it's a number, right? So let's go in and play here for a sec. So here's the quarterly index. And so here's the first time affordability index for printing. And the average number for the average person is 100. If it's above that, it means they can afford more house than the average person. If it's below that number, it's less house. But you have to understand, this is the National Association, and if this is one document and it does not give you anything about the community, it's lumping all of America together. So 2018, we have the first time affordability index at 94.4. It's still okay, or maybe the composite. Yeah, so 143. And I don't actually know, but the qualifying income here is the 52,000. So the prime first time median income, so those people make a little less money, so they're not affording as much house as they could. But that doesn't tell us everything. But I can tell you before the crash, this number was very, very low. All of these numbers, this number in the composite was like way under 100. So it's still a good time. People can still afford a lot of house, right? Depends on your area. So let's look deeper, right? So those are the quarterly. We can go into the metropolitan. Now this is 2016. They have not published 2018 yet. And so, but we can interpret off what's happened since 2016. So it's a function of monthly payment. So if a monthly payment is affected by a couple things. One is your interest rate, and the other is by how much is the house, right? So you need to know that if the interest rate changes, The affordability index, if the interest rate goes down, people can afford more, right? Because the interest rate's lower. If the interest rate goes up, the affordability index goes down. Same thing on pricing. If pricing goes up, the affordability index goes down, and as pricing goes down, it goes up. So in the downturn, the affordability index got to be a good higher number again, right? And so as prices go up, it goes down. And so 100 is the good baseline number where the average person can afford. So therefore, we should see when we look at this form, because California, even when it corrects, is always going to be more expensive, right? A lot of people, a lot of execs just rent there because it's very, very expensive, right? So let's look. So what we're going to do is, this is 2016, so we know prices are a little different since then. Interest rates changed a little, so the indexes have probably decreased because prices actually have come down or went up since then, and interest rates have come up. So actually, the affordability index is probably lower than whatever numbers we see. So in Akron, Ohio, the affordability index in 2016 was 227 or 311. That's insane. That's great. But look in Anaheim here. Anaheim right here, 67.1. So you can't, the average person can't buy a house. They buy less than what the average norm would be for the US, right? So you go down and you compare your city, right? So you get an idea of your city. Dayton, Ohio here is 267. Now it's my guess would be, I don't know, we could go to the Dayton, Ohio people, and the realtors should be able to get the affordability index from their board. But if they don't, it's probably still around 200-ish or a little less, which is still very good. Anything above 100 is very good. So you go down here, and there's a lot of affordability in 2016 in these communities. And when you see them be a little bit lower number, we're going to see San Francisco, San Jose. The lower numbers are Honolulu. So those are your more expensive communities. Not that you're not going to do deals there, but you better be knowing what's going on in those marketplaces. And there's flips and all to do there, but you want to know what's going on in that marketplace. So that's the affordability index. So that's a good way to check things out, and then couple that with try 3 ways. Do the affordability index, then go to Realty Track, and then let's find a realtor or 2 in a new community and get them to work for you and see who can give you the right information. Not a lot of realtors know how to find this information. The ones that do and who can tell you in depth information like this, you may be teaching them some of these statistics and how to analyze. It just depends. I love them, but we aren't taught this information in realty school, and that's kind of why Jason and I are doing this. So historical information as well can be gotten from the realty board, and they probably charge for that. But this will give you a good way to get started and select a community and what's going on. Now, communities can be affected by the anomalies that we talked about before. So when you decide on a few communities that you're looking at, see what's going on there. And people might not even be talking about it. It might be coming in subtly. It could be a big corporation coming in or a big corporation leaving. Those would be signs that something's going to happen to the marketplace. It also could be a new law. So when marijuana is allowed in a state, then that changes things in that state, right? And so you have to put your new goggles on and say, okay, what's going to happen here, and what are people going to be trying to do? When oil is introduced to an area, it changes things. It can be good, and it can make things go good. And if the price of oil drops significantly, it can make things go soft for a while too. So you want to know all those ins and outs. When Zillow decides to open up in Raleigh, North Carolina, they're doing that for a reason. There's a lot of young millennial techs there, right? There's a lot of tech in North Carolina. It's a technology state. It's the innovation state, right? And so there's a reason. And so is that an anomaly? Yes. What's going to be there? What do those people want? Provide it for them. The millennials didn't get into the game, during the downturn, and they didn't buy houses because they'd seen their parents get beat up and all kinds of things. So what is it that they want? Well, go give it to them if that's a community that you're doing. If it is the military there, is it a strong military base? Is it one that they thought of closing? I don't think they're closing too many these days. My father was military, so I'm always looking at those things too. but that's a steady source of rents, right? So is it an area where people are wanting to move, or are they wanting to move away from, right? So look at all of those things and make good decisions for where you want to invest in real estate. So let's do this thing.